Welcome to another video. Today we will discuss the pros and cons between debts and equity financing contracts.
If you follow the debates or criticisms on Islamic financial institutions within the Muslim community, Islamic economists, when they started the idea of Islamic banking and finance, they really have high hope for Islamic financial institutions to emerge as a key player of reviving the economy. What I mean here is, for Islamic economists, when they give this idea of Islamic banking and finance, they hope that Islamic financial institutions to use a lot of equity financing rather than debt financing. The practice today is most of Islamic financial institutions are utilizing a lot of debt financing contracts for their revenue. However, scholars prefer equity financing because according to some Islamic economists, they argue that equity financing, forming joint venture through musyarakah or mudarabah, is good to the economy because it promotes or it will generate economic growth. Meaning, it stimulates real economic activities. People get employed, suppliers get businesses coming to them, and then value are created in the economy because now the joint venture will produce some products or services. Here we talk about participation in the economy by workers, and then the economy also will be more productive because we are talking about real economic activity, real output, value added are generated, people get work. In contrast, if you look at debt financing, what I mean by debt financing is this one, based on this model. Housing loan, using murabaha and bank bitaman ajil. In contrast to equity financing such as musyarakah or mudarabah here. What's the problem? For Islamic financial institutions, they prefer debt financing because number one, debt financing is low risk. However, for equity financing, it is risky, higher risk. For the debt financing, it is low risk because Islamic bank just become the middleman. They wait for the money to come to them by monthly installment. So then we can say that the Islamic bank can enjoy steady income stream coming from those who get the housing loan from them. If you look at equity financing, there is no certainty on when the business or the joint venture will make profits. The cash flow can be bad. There's uncertainty about the profits. Maybe the business or the joint venture will incur loss. So there's a risk, there's uncertainty, there's no steady income to the bank. That's why bank does not really keen on equity financing. And then another point, under the debt financing, relatively speaking, it's short term. Like housing loan in Malaysia, maximum is around 35 years on average. And then for car loan, maximum is 9 years. Short term, relatively speaking. But if you talk about equity financing, once the Islamic financial institution form the joint venture, they are locked for long-term partnership. Imagine if everyone in our class approaches Bank Islam with our proposal to form a joint venture with Bank Islam. It's not easy to manage. So therefore, there will be high management cost. But for housing loan under Murabahah or Bitaman Ajil models, there is a low management cost because the bank only need a few staff to monitor payment every month. So that's easier to manage. Therefore, we find in many Islamic financial statement reports, huge proportion of revenue and profits come from debt financing contracts and very limited percentage come from equity financing. So that's why up until today, you will find debates between bankers and the Islamic economists. So that's therefore become a frustration to many Islamic economists. Economists, they want to see real economic activities. Economists, they don't like financial institution become the middleman because the middleman would create higher price. And then the controversies underlying the contracts, like by Al-Inah also, is another issue. So those are the points that I want to highlight in relation to some of the common models used by the Islamic financial institutions.
Don't forget to subscribe, like, and share the video. Thank you.